Welcome back to the Business Broker Expert channel. Don't forget to like and subscribe to be notified of our next episode. Today we're going to talk about the big, beautiful bill and how it will affect business sales in a great way. If you own a business and you've thought about selling, even in the next few years, you need to pay very close attention. For months now, we've been telling our clients that 2026 is shaping up to be a significant year for business sales. And this isn't hype. The data supports it. The buyer behavior supports it. And now the tax law supports it. Private equity has record capital that has to be deployed. Family offices are actively searching. Strategic buyers are calling us weekly, and individual buyers with real operating experience and real money are back. Now, with the passage of the One Big Beautiful Bill Act, there is another major reason to pay attention. This legislation permanently changes several tax provisions that directly impact how businesses are valued, how buyers structure deals, and how much sellers ultimately keep. If you're considering selling in the next 1 to 5 years, understanding this is no longer optional, it's essential. Before we even talk about taxes, let's talk about what we're seeing on the ground. We're in a rare window. There's a large amount of capital chasing a limited number of quality businesses. Private equity dry powder is near historic highs. Family offices are shifting away from public markets. And millions of baby boomer owners are approaching retirement at the same time. That creates pressure. Pressure to deploy capital. Pressure to find good companies. Pressure to compete. And when buyers compete, valuations rise, deal terms improve, and sellers gain leverage. What we're already seeing are more inbound buyer calls, more multiple offer situations, and faster deal timelines. Now layer the new tax law on top of that, and you start to see why 2026 is shaping up to be so important. One of the biggest changes is the return of the 100% bonus depreciation. Under the new law, buyers can immediately expense qualifying equipment and property placed in service in 2025 and beyond, not phased in, not partially, 100%. This is a major win for buyers. Instead of writing off assets over many years, they can expense them immediately. That increases first-year cash flow, that improves return on investment, and it makes debt easier to service. Here's why that matters to you as a seller. When buyer cash flow improves, buyer purchasing power increases. They can justify higher offers. They can handle more leverage. They become more aggressive. We're already seeing this show up in negotiations. If your business has significant depreciable assets, this provision makes your company more financeable and more attractive to serious buyers. Next, something that quietly has a big impact. The qualified business income deduction is now permanent. This affects S-corps, LLCs, and partnerships, which is how most privately held businesses are structured. Before this bill, the QBI was scheduled to expire. That created uncertainty. And buyers do not like uncertainty. Now it's permanent. That means buyers can consistently model up to a 20% deduction on qualifying income. Why does this matter? Because buyers don't buy revenue. They buy EBITDA, earnings before interest, taxes, depreciation, and amortization. They buy after-tax cash flow. When buyers can predict what they will actually keep, they build stronger models, accept higher prices, and move faster. Stable tax rules encourage acquisitions. That's just reality. Tax rate predictability changes the conversation. Another major shift is tax rate predictability. Before this law, buyers were forced to build in what-if scenarios. What if rates go up? What if deductions disappear? What if returns compress? So they discounted offers. They slowed down. They added risk premiums. Now much of that policy risk has been removed. And in deal-making, uncertainty kills more transactions than bad businesses ever will. With clear, long-term rules, buyers can model 5-year returns with confidence. That makes deals easier to finance, easier to agree on, easier to close, and cleaner math leads to cleaner transactions. The SALT cap increase, which is the state and local tax deduction cap, has also been raised to $40,000. This primarily affects owners and buyers in high-tax states. This means more deductible taxes, more personal cash flow, and stronger after-tax outcomes. For sellers, that improves net proceeds. For buyers, it improves acquisition affordability, and cash flow always drives deal activity. Here's what this means for your timeline. We tell every client the same thing. Markets move in windows, and the best exit windows occur when buyers are active, capital is abundant, and rules are favorable. Right now, all three exist. The one big beautiful bill did not create this market, but it removed friction. It gave buyers clearer math, more confidence, stronger economics. That does not mean you rush. Preparation still matters. Clean financials, strong management, transferable operations, a clear growth story. But if you're within a striking distance of selling, the conditions are clearly shifting in your favor. Here's the bottom line. The new legislation improves the economics of buying businesses. Buyers can expense investments faster. They can count on stable tax treatment. They can model returns reliably. And when buyers are confident, they pay more. They move faster. They compete harder. That's exactly what we're seeing. And that's why 2026 is shaping up to be one of the strongest exit environments we've seen in over a decade. If you want to talk through what this means for your specific situation, we're happy to have that conversation. No pressure, no pitch, just clarity. And if this content is helpful, make sure to subscribe to Business Broker Expert for weekly insights business owners need before they sell. Thanks for watching.